It is Sunday morning. Somewhere on the east-west line, three people are sitting 3 carriages apart on the same train. Amira is 31, marketing executive in Tampines. No debt, not $1. She is reading a book. She does not think about money on weekends. Jason is 44, operations manager in Bishan. Mortgage, car loan, 2 credit cards. Standard middle Singapore. He is scrolling property listings, thinking about upgrading to a condo. The numbers technically work. He keeps checking. Nurul is 52, administrative assistant in Woodlands. She owes 11 bags. The total is $437,000. Last Tuesday, her debt consolidation plan application was rejected. She is looking at her phone but not reading anything. She is just holding it. 3 carriages, 3 versions of the same life. The distance between Amira and Nurul is not income, not intelligence, not luck. It is a sequence of decisions that each made complete sense at the time. Singapore has no minimum wage, no universal welfare net, and a CPF system that returns your money, but not always in the form you expected. In that environment, debt is not an accident, it is an architecture. And most people do not realize what they are building until the structure is already around them. Amira has no debt. She also has something most people underestimate. She has options. She can take a job that pays 20% less because the work is better. She can leave Singapore for 6 months without calculating whether rent will be covered. She can say no to overtime without the anxiety of a shortfall. She can invest aggressively because nothing is pulling against her. This is what zero debt actually buys. Not luxury, not early retirement. The ability to make decisions based on what you want instead of what you owe. The median gross monthly income in Singapore is $5,775, according to MOM's February 2026 release. After CPF, $4,936 reaches the bank account. After rent, food, transport, utilities, a realistic floor for a single person, roughly $2,500 to $3,000 remains. That remainder, invested every month for 30 years, is the gap between financial fragility and financial independence. Amira puts $2,200 into a monthly RSP into CSPX, the Irish domiciled S&P 500 ETF that charges 15% withholding tax on dividends instead of 30% on the American domiciled VOO. No US estate tax. She started at 26. At 7% average annual returns, $2,200 per month from 26 to 65 is approximately $6,400,000. She does not feel rich. Most months, she does not feel different from anyone else on the MRT. But the clock is running in her direction, not against it. The action. Go to cpf.gov.sg and make the $8,000 RSTU top-up before December. 8,000 into SA at 4% compounding is 11,800 in 10 years with no further additions. The tax relief at the 18% bracket saves $1,440 immediately, before the investment earns a single cent. The clock at zero debt is the only clock in Singapore running entirely in your favor. Now move higher. Hafiz is 37, senior engineer. He and his wife Deepa bought a 4-room HDB resale in Bedok at $585,000. Bank loan locked at 1.75% in March 2026. Monthly mortgage $2,040 paid from CPF ordinary account. He does not feel that $2,040. It leaves CPF before it ever reaches his bank. That is the first thing to understand about a Singapore mortgage. It is designed to be invisible. And invisibility creates a dangerous assumption. Because the mortgage is handled, retirement is handled. It is not. Every dollar Hafiz uses from OA earns 2.5% instead of 4% in SA. On a $400,000 loan over 25 years, that gap in foregone returns is approximately $120,000. Not lost to a bad investment, lost to a form he never reviewed. And then there is the rule that surprises almost everyone at the point of sale. When Hafiz sells the flat, CPF reclaims not just what he withdrew. It reclaims the principal plus 2.5% accrued interest for every year every dollar was out. If he withdraws $300,000 over 20 years, CPF's refund at sale is approximately $410,000. The flat appreciates, but the cash in his hand is consistently lower than he expected, because the refund is larger than he remembered. The mortgage is the shelter. It is not the retirement plan. Those are two different things, and they require two different accounts. Here is what the confusion costs in concrete terms. The CPF life payout for someone who hits the full retirement sum, $220,400 by age 55, is approximately $1,780 per month from 65. The Singlife Financial Freedom Index found that Singaporeans themselves expect to need $2,856 per month in retirement. The gap is over $1,000 every single month, and that assumes Hafiz hits the FRS, which requires active planning beyond just paying the mortgage. His action: $8,000 into SA via RSTU every January. Tax relief at the 22% bracket saves $1,760 immediately. $1,500 per month into CSPX via RSP. The mortgage handles the roof. The RSP and the top-up handle everything after. Here is where it starts to turn. Jason earns $10,000 a month. 4 years ago, he upgraded from HDB to a condo in Serangoon North at $1.2 million. Bank loan, $900,000. Monthly mortgage, $4,600. He also bought a BMW 3 Series, Category A COE, at $126,009 in June 2026. Total car cost all in, $228,000. 7-year loan. Monthly repayment, $2,700. Fixed debt obligations every month, $7,300. After CPF and tax, roughly $8,200 reaches his account. After the mortgage and car, $900 remains. $900 for food, utilities, fuel, insurance, phone, condo maintenance fees, and everything else. $900. He does not feel broke. The condo is real. The car is real. The lifestyle is real. The number that is not real is the assumption that this is survivable through one unexpected event. In 2024, 60% of Singapore workers reported living paycheck to paycheck, the highest rate in Asia Pacific, according to ADP research. Not the poor, middle-income earners with assets they cannot sell and obligations they cannot pause. Jason's combined debt servicing is 89% of take-home pay. That is not a margin, that is a wire. He and his wife have not argued about debt. They have argued about the holiday they cannot take, the renovation they keep postponing, the fact that they have not had dinner out, not hawker center, a real dinner, since January. The financial stress does not present as financial stress. It presents as everything else. There is also a number Jason has not calculated. The $1,800 he stopped investing when he upgraded. The RSP he paused to cover the higher mortgage. Over 27 years at 7% is not $1,800 per month. It is approximately $1,800,000. The upgrade did not just cost him square footage. It cost him the years when that money should have been compounding. The action: calculate your debt servicing ratio today. Every fixed monthly obligation divided by gross monthly income. Above 55% is MAS's warning threshold. Above 70% is a structural problem that no salary increase alone resolves. Jason does not need more income. He needs 18 months of buying nothing, and every freed dollar directed into a liquid emergency fund. 6 months of his household expenses is approximately $44,000. He has $11,000. One hospital bill, one retrenchment letter, one car problem, and the wire snaps. And then there is the level most people do not realize they have already entered. Wei is 48, IT consultant, self-employed. Good months 9,000, slow months 4,000. 3 credit cards, DBS Altitude, OCBC Rewards, Standard Chartered open for the sign-up bonus and never cancelled. Combined outstanding balance 38,000. He does not think of himself as someone with a debt problem. The balance moves. Some months he pays it down. Some months it climbs. It has sat between 30 and 40,000 for 3 years. He pays the minimum, 3%, on 2 of the 3 cards. Here is what 3% minimum on 38,000 at 27% annually actually means. Month 1, $1,140 paid. $855 goes to interest. $285 reduces principal. At this pace, with no new spending, the balance is cleared in 31 years.
Total interest paid, $83,000 on $38,000 of spending. He will pay back $121,000 for purchases that happened mostly between 2022 and 2024. MAS data. Credit card rollover balances in Singapore hit $9.07 billion in the third quarter of 2025, a record, the highest in over a decade. The average rollover balance per cardholder is $5,335, 86% of the average monthly income. Most of these people do not think they have a debt problem. They think they have a cash flow inconvenience. One gets addressed, the other gets managed. Wei has been managing for 3 years. There is one more thing Wei missed. He has been earning air miles and cashback on every dollar spent. This feels like a gain, a smart move even. The 27% annual interest on the rollover balance erases every rebate he has ever earned on all 3 cards and then charges him $83,000 more on top. The miles are real. The math behind them is not what he thinks it is. For people whose unsecured debt exceeds 12 times monthly income, the MAS Debt Consolidation Plan consolidates everything into one loan at 7 to 10% EIR, against the 26 to 28% on the cards. Wei at a $6,000 monthly average earns a threshold of $72,000. He is at 38, below the line. His option is a balance transfer. Every major Singapore bank offers 0% balance transfer for 6 to 12 months on a handling fee of 1 to 1.5%. On $38,000, the fee is approximately $570. Compare that to the $8,560 of interest he pays this year if he does nothing. Call your bank this week. Ask for the balance transfer rate in writing with the handling fee included. Before the next interest cycle closes, here is where the system itself runs out. Linda is 53, former retail manager, retrenched 8 months ago after 14 years at the same company. Ad hoc work, 68,000 in unsecured debt across 4 banks and 1 licensed moneylender. Income this month, 2,300. She applied last week for the Debt Consolidation Plan. Rejected. Not because her debt is too low, because her income is too irregular to service the consolidated repayment. The system built to help people in debt has decided she is not the right kind of person in debt. To qualify for DCP, Singapore citizen or PR, annual income between 20,000 and 120,000, unsecured interest-bearing debt above 12 times monthly income, net personal assets below 2 million. The income requirement is a hard line. There is no appeal. The 68,000 at 27% is costing her $1,350 in interest alone each month. She cannot service it, cannot consolidate it, cannot clear it. There are no savings. What remains is the Debt Repayment Scheme. The DRS is a pre-bankruptcy program through the Ministry of Law's Insolvency Office. Accessible only via court, either she files or a creditor files against her. To qualify, unsecured debt below 150,000, regular income, not bankrupt in the last 5 years. She is at 68,000. She qualifies. A plan of up to 5 years is structured with the official assignee. Creditors cannot pursue legal action during this period. Her HDB and CPF are protected. The retrenchment did not create the debt.
It removed the income that was keeping the debt invisible. Action. Call Credit Counseling Singapore at 1800 222. Free, confidential, backed by the Association of Banks in Singapore. They have restructured obligations when banks would not. The window for DRS is only open before bankruptcy is declared. Once the court order is made, DRS is off the table. Do not wait. And then there is bankruptcy. Kumar is 49. His logistics business failed 18 months ago after a supply chain collapse. He had personally guaranteed the company's bank loans. Total exposure, 380,000, above the DRS ceiling of 150,000. His personal credit lines and loans taken to keep the business alive, another 200,000. His creditors filed. The court made the order. He is an undischarged bankrupt. He is still in Singapore. He cannot leave without written approval from the official assignee, submitted at least 14 days before travel. His daughter's graduation was in Melbourne. He applied. He was approved. He went. But the approval was not guaranteed, and he knew it from the moment she sent him the invitation. He cannot be a company director, cannot manage a business, cannot borrow above $1,000 without disclosing his status in writing, cannot enter Marina Bay Sands or Resorts World Sentosa. Undischarged bankrupts are legally barred. His CPF, OA, SA, MediSave, is fully protected by law. His HDB, co-owned with his wife who is a Singapore citizen, is protected under the Housing and Development Board Act. What was not protected? His CPF investment scheme portfolio, $41,000, transferred to the official assignee, liquidated, distributed to creditors, gone. He works. A friend hired him in a non-managerial role. A portion of his salary goes to the bankruptcy estate every month. The OA calculates it against his income and living costs. He keeps the rest. He receives a payslip. He is allowed to live. In 2025, Singapore recorded 1,623 personal bankruptcies, the highest since 2019. In the first quarter of 2026, 482 cases, against 378 in the same quarter the year before. The trend is up. Ministry of Law data from 2016 to 2025. 40 to 54-year-olds made up 47% of all bankruptcies. Not reckless 20-somethings, mid-career Singaporeans. The 5 causes according to MinLaw: business failure, overspending, retrenchment, guarantorship, income too low for basic needs. Guarantorship is the one most people dismiss. You sign because you trust someone, or felt obligated, or were asked at the wrong moment. If they stop paying, the bank does not call them first. It calls you. Full amount, immediately. Filing costs $1,850 as a deposit to the official assignee. By the time most people reach this point, that money does not exist in liquid form. Kumar expects discharge in 3 to 5 years. IRAS debts and CPF arrears survive bankruptcy. Those still must be settled. But the commercial creditors, the bank loans, the guarantees, resolved through the process. He is building back, within a structure he did not choose. Action. Go to io.mlaw.gov.sg before a creditor files against you. Understand whether DRS is still available. A voluntary filing is different from an involuntary one. The window closes the moment the court order is made. Paralysis at this level is the only decision that has no recovery. And then there is the level where no institution in Singapore can formally reach. Nurul is there. After her divorce 3 years ago, she began borrowing from licensed moneylenders, registered with the Ministry of Law, interest capped at 4% per month, loan amounts capped at 6 times monthly income for borrowers earning below 30,000 a year. She used 3 of them. She reached the combined cap. The money still was not enough. Someone introduced her to someone else. She borrowed once from an unlicensed source. She told herself it would be 1 month. It was not 1 month. Unlicensed moneylending has no interest cap, no contract, no complaint mechanism. Rates documented by the Singapore Police Force, 20% per week. Cases on record where 10,000 became 400,000. Not through fraud, through compounding at rates no regulated institution can legally charge. Nurul also lost $73,000 to an investment scam in 2022.
A crypto platform that showed a growing balance she could never withdraw. By the time she understood, she had borrowed from 3 additional sources to keep funding what she believed was real. In 2024, Singapore recorded $1.1 billion in total scam losses, the highest ever. She was one of 51,501 reported cases. She cannot file for DRS. Her debt exceeds 150,000. The unlicensed portion has no standing in a Singapore court. You cannot list an illegal lender as a creditor. The licensed debt is potentially addressable through bankruptcy. The rest is a different problem with no clean legal solution. The resources at this level: SPF Anti-Scam Command at 1-800-724-5664. Family service centers in every HDB estate. Financial counseling, Comcare applications, legal aid referrals. MinLaw's Legal Aid Bureau for citizens and PRs who cannot afford a private lawyer. None of it is fast. All of it is better than silence. 3 carriages on the east-west line. Amira gets off at Tampines. Kaya toast. Kopi C. The weekend is entirely hers. Jason gets off at Bishan. In the lift he sees a message. A friend from NUS just bought landed in Serangoon. He feels something he does not name. He lets himself into the condo and puts his keys on a kitchen counter and stands there for a moment. Nurul misses her stop. She realizes at Jurong East and waits for the next train back. She has a 2 o'clock appointment at a family service centre in Woodlands. She made it 9 days ago. She almost cancelled twice. She did not cancel. That appointment is the first decision in 3 years moving in the right direction. The architecture of debt in Singapore is built in steps, and almost everyone enters from the reasonable end. A mortgage that makes sense, a car that feels necessary, a credit card for the miles, a loan for an emergency that did not go away, a second loan to cover the first. Each step is logical from inside it. The direction only becomes visible from outside. The most important number in Singapore personal finance is not your salary, not your CPF balance, not your net worth. It is your debt servicing ratio. Every fixed monthly payment divided by gross income. Below 30% and you are building. Between 30 and 55 and you are in the structured zone. Above 55 and 1 event, 1 retrenchment, 1 medical bill, 1 month without income can cascade into years of recovery. Calculate it today. That number is the real number. Not the lifestyle, not the postcode, not the car in the car park. The gap between Amira and Nurul on that train is not 30 years of bad choices. It is a sequence of individual decisions, each reasonable when it was made, each compounding quietly in a direction that was never meant to be permanent. Debt does not announce itself as a problem. It arrives as a mortgage that makes sense. A car that feels necessary. A credit card minimum that feels manageable. And then one day you are sitting on a train, holding a phone you are not reading, trying to work out what comes next. Which level are you on right now? If this video changed how you see that question, share it with one person who needs to see it. They probably already know something is wrong. They just have not had a name for the level they are on.